Dave Ramsey's helped millions of people get out of debt, but I'm not convinced he's helped very many people actually create wealth. What up guys, Ben Obrick here, back with another video. Today, before the whole Dave Ramsey cult comes after me, I'm actually gonna provide statistics, real results, and actually show you my strategy that completely opposes Dave Ramsey investing. And it's actually a much more accelerated way to build wealth, get you out of retirement, help you actually build cash flow and create real wealth. One of the things that Dave Ramsey has done good at, and what I love is, hey, don't have credit card debt. Live below your means. Have a security fund for emergencies. I believe in all of that, and I think that's great advice. But if you're sitting here watching this today, here's what we're going to go over. We're going to go over smarter investing strategies that are going to help you build real wealth on an accelerated pace, pay less taxes, and not stay locked in retirement funds, 401ks, IRAs, or traditional assets. Here's the bottom line, guys. If you want to be able to 2x to 3x your money every 5 to 7 years and multiply your wealth, pay less taxes, have more leverage, more options, and not have to wait till you're 59 and a half to access your money, then this video is for you. I don't care if you're a working class American, I don't care if you own a business, you're high net worth, or you're somewhere along the lines of maybe saving $1,000 a month. If you're any of that audience, this video is for you. Okay, so let's break down the Dave Ramsey investing. And I promise by the end of this video, I'm gonna give you my full strategy, the deals I actually do, ones that you can even get involved with. I'm gonna show you the returns of those deals and how I multiply my wealth, hedge inflation, and I pay very little to no taxes with this strategy. So with Dave Ramsey, here's the thing that we see. We see don't have debt, okay? I'm gonna say right now, there's good debt and there's bad debt, okay? Bad debt is on your home, all right? Your home is not an appreciating asset. It's not an asset that makes you money. A home is not an asset. A rental home, yes. Your personal home is not an asset. To buy a home and own it in cash instead of investing in cash flow and things that make you money is dumb, especially when rates are as high as they are, especially when the average home price is $420,000 in America, and especially when the population buying the homes right now are the millennials that have massive student loan debt, got 6 degrees, and still don't make $100,000 a year to afford the average home in America. So a home is a stupid decision to begin with, and the fact that you're gonna save and save and save money and not invest it and own something that doesn't make you money is gonna keep you locked out of financial freedom, okay? The next thing is retirement accounts. Historically, okay, I don't care if you look at S&P data, I don't care if you look at financial analytics on Google, you're gonna see 7 to 10% is your annual average return on retirement accounts, okay? And I don't care about the employer match either because I make 25, 30% of my money annually, okay? Sometimes even more, but if you're not making 25 to 30% annually on your money, then you're going to die broke. You're not able to create wealth. You need to make 25 to 30% on your money every year. So 7 to 10%, bad. No debt, there's bad debt and there's good debt. Having debt on a car that's going down in value, bad debt. Having credit card debt, bad debt. There's many forms of bad debt, but there's also good debt. Good debt is utilizing debt on assets that appreciate, which we're gonna talk about in a second. A house, having debt on a house is not a good idea, all right? Because how many of you guys can honestly say you're making double payments on your mortgage? You're not, you're not. So by the time you pay off that $500,000 mortgage, you've paid another $700K in interest, and the house hasn't appreciated that much. If you get a $500,000 mortgage, okay, and you end up paying $700,000 in interest by the time the loan is paid off, that house hasn't appreciated to $1.2 million in value. You're not even break even, right? You just made the bank more wealthy. Okay, so if you want to actually build wealth, we need leverage, we need to be able to multiply, we need to be able to repeat the process, and we have to hedge taxes and inflation. So I'm going to tell you a few ways to do that, okay? And for those of you that have retirement accounts in here, all right? You got a Roth IRA, you got a traditional, you got a 401k. If you have one of those, the big thing that you are exposed to is taxes, okay? If you invest in a retirement account for 40 years, right? You got 30 years of inflation. Now, inflation historically in the last 100 years is 2.65% in the United States. In the last 30 years, it's been closer to 3.2%, right? So if you're only making 7 to 10% here in your retirement account, okay, and let's leave taxes out of the equation for now, you're only gaining 4 to 7%. That's not getting ahead. And then when you're locking your money away for 40 years and you're not able to multiply it or leverage it or invest it in assets that make you more money, you're exposing yourself to more taxes, more inflation, and a loss to time. So if you want to make 7 to 10%, I'll just tell you right now, buy gold or silver, okay? In the last 30 years, gold's had an average annualized return of 10.9%. Silver's been 9.2. If you want to make 7 to 10% and your retirement account doesn't allow you to self-direct into assets that make more than 7 to 10%, why would you not just buy gold or silver? You can sell it anytime you want, you get rid of it anytime you want. You don't have fees when you do it. You don't have to wait till you're 59 and a half. If you want to make this, buy gold and silver, okay? Gold just hit $3,700 an ounce the day before I recorded this video. You saw rate cuts on the 17th of September. You saw 25 basis points. Why does gold go up? Well, when rates cut, the dollar weakens. The paper assets your retirement account is invested in, stocks, mutual funds, ETFs, those are paper assets. They're more exposed to inflation. So when the rates drop, the dollar weakens and non-yielding hard assets appreciate. That's why we saw more retail investors, people like you and me, and institutional money buy more gold in anticipation of that rate drop. So gold hit a record, and the same companies that own gold, like BlackRock, that controls $12–15 trillion of assets, guess what? They also own interest in some of the top producing gold mines, like the Stibnite mine in the United States. BlackRock is a major interest party in that mine because it can produce 450,000 ounces of gold over the next 10–15 years, okay? So of course, you can be a BlackRock analyst and say, hey, we believe gold is gonna hit $4,000 an ounce because you actually own the mines extracting the gold. It's very funny. So if you wanna make 7 to 10%, just buy gold and silver. Now, obviously, we've seen gold double in the last 3 years. So 10.9% average 30 years, but in most recent years from 2020 forward, it's had 20, 30, 50, 80, 100x returns in very short periods of time, okay? So if you wanna make 7 to 10, we do this. If you wanna build real wealth, we do the strategy that I'm gonna talk about in a second. By the way, guys, before we continue, if you're brand new to my channel, all I do is expose financial truths that are contrary to the industry and what we've been led to believe. The average advisor makes $110,000 a year, and I don't believe you should listen to people that took a test and said they're God's gift to the financial world and trust somebody that makes $100K a year on what to do with your money. I only listen to multimillionaires and billionaires, and if you're not wealthy, why would I use your advice? It makes no sense. So one of the things, going back to Dave, before I get into my investing strategy, and I promise this is for you regardless of where you're at in life. If you're brand new to investing, you're just getting started, you're a sophisticated investor looking for tax strategies to offset your earned income, you want more depreciation, you want to offset passive income, you want to multiply your wealth passively, we're going to get into that in just a second. So Dave says buy term, invest the difference, buy term insurance. I'm here to build wealth now. Term insurance has no cash value. So I want to keep my money where it's making money and then use that to invest. So what I use is whole life insurance. I've made videos on this, I'll include it in the description. One of the big problems here, okay? I get hated on all the time because I use whole life insurance, and these advisors love to use index universal life policies, okay? Just so you know, let's just cut to the chase. A properly structured whole life policy should generate an 8 to 12% internal rate of return. Now, when you get into what is called a high early cash value dividend paying whole life policy and you start contributing to that, you can build it up to the point where they typically, okay, and it's different for everybody because different policies are structured differently, but the policies that I'm in do 8 to 12% internal rates of return. What does that mean? There's this thing called the rule of 72, which allows you to figure out how long of a period of time do you need to be in an investment to, for example, double your money, okay? So if I am getting a 14.4% internal rate of return, I can take 72 divided by 14.4, and let me know in the comments, if you do that right now, what is 72 divided by 14.4, okay? Let me know in the comments. You're gonna come up with a number, and that number is how many years it will take to double your investment, okay? At a 14.4% IRR, internal rate of return, I am doubling my investment every 5 years, okay? If I cannot double my money every 5 years, okay? Before I get into the advanced strategy we're gonna talk about in a second, I'm not interested. So if I'm keeping my money, not in this stupid term policy, but I'm keeping it where I'm getting 8 to 12% internal rate of return, all right? I'm already more than halfway there. So that's the first thing. I keep my money stacked up in this cash value dividend paying whole life policy. That's thing one, okay? Then from there, I wanna go into assets that appreciate. So I'm going to talk about the assets that I go into, specific ones in a second here. I want to break down a couple more things. A lot of advisors will say, hey, if you're going to build cash value in an insurance policy, do an index universal life policy. I've made videos on this. Of course you'd say that because you're getting a 50 to a 90% commission if you're an advisor selling this, okay? An advisor that called me out saying that you cannot have internal rates of return that are 8 to 12% in a whole life policy and that IULs outperform whole life all day long, okay? And then he realized he was wrong and he said, hey, you know what, you're right. The institutional grade ones, like the ones you're talking about, they perform very, very well. That's why banks buy them. Banks bought $11 billion worth not too long ago. So I go into whole life. Now you also have to realize, I actually had a couple people make some kind of hate videos about infinite banking and about investing in life insurance here, and they were financial advisors. And they must think that we don't know, what we're doing here, but we looked them up and these guys aren't even licensed to sell the type of products that I'm talking about. And I myself am not an advisor. I don't get paid anything to teach this, but I want to expose the truth. That's what I care about, okay? With whole life, I get that 8 to 12%. I'm going to tie all of this math together in a second here, and in a little bit, I'm going to tell you how you can get involved in these. And again, regardless of where you're at in life, I don't care if you're 20 years old, 70 years old, anywhere in between. Doesn't matter if you've got a significant amount of capital to start with, a little bit, anywhere in between that. You're a business owner, an employee, you got a big tax problem, you need to multiply money and get rid of stuff fast and get into the right assets. All of that stuff we're going to be able to solve for you. Okay, so back to the rule of 72 here. 14.4% IRR is what it takes to double my money every 5 years, okay? Now, if I am saving in my policy here, okay, and I get just an 8% internal rate of return, all right? And I add that to the 14.4 I'm getting here, that's 22.4% internal rate of return between where I'm saving my money, because I'm not doing it in a savings account, even if it's high yield, I don't want to pay the taxes on it. I am saving over in here where I'm getting 8 to 12%. I'm giving the conservative scenario based on my own results. An 8% IRR plus a 14.4 where I invest. That's 22.4%. Do the math. What does that mean? Where I save my money and where I invest my money into allows to double in 3.21 years. Okay, now what do I invest in? That's the question you guys are asking. What does Ben invest in? Okay, so here's a deal. This is in Kansas City. This has a little bit north of a 19.1% internal rate of return. 5-year real estate deal. Not all markets are created equal. You cannot do this in every market. That's why I invest in markets that I understand, that I know have high rent growth, that I know will appreciate. Okay, so this deal is a 19.1 or so IRR, which means it's going to do about 2.37x in a 5-year period of time. So I'm actually getting a 19.1% right there in addition to my 8. That's over 27, okay? And again, I'm staying conservative here. As you contribute more, again, into a properly structured whole life policy that is institutional grade with the right carrier, you can actually increase this internal rate of return as time goes on, all right? In the earlier years, it's a little bit lower. Later years, it can start accumulating. That's why you accumulate cash value in these life policies. So I got 19.1% here in this last deal, 19.1 IRR, and I just showed you that deal. This next deal that we're doing, we already own the land. It's right next to the existing apartment complex that I just showed you guys, and we already own the land here. We're doing another 240 units, and what's really cool about this deal is it's a non-accredited fund, so non-accredited investors can get into it, accredited investors can get into it. And we penciled it out, we went through the math, and we're like, over a 5-year period, we see north of a 20% IRR. So if I'm getting a 20% IRR here, right? And we know that our aim on this deal is an exit in 5 years. I'm doing a lot more than doubling my money in that 5-year period of time off of this real estate investment, and then add in what I'm getting over here in the whole life policy. That's a pretty damn good return. And I'm going to show mathematically how that compares to a Dave Ramsey investing strategy, a typical traditional asset retirement account strategy. I'm going to actually break down the math. Now, the other asset that I didn't talk about here is I like oil, okay? Big misconception about oil. A lot of people think that you always have to be accredited to invest directly into oil wells. Most of the time, that is the case. But there are what is called Regulation A funds. And Regulation A funds allow non-accredited investors to get involved and participate directly into oil drilling. I don't own oil stocks. I am participating in horizontal oil wells where there are vertical rigs put up and they're connected together so they can go across a very, very big pool of an oil deposit, all right? Huge tax benefits on that. I've made videos about that. I'll include that in the description as well. But oil deals come with massive tax benefits, able to write off a huge portion of your investment capital in the year you invest. They come with good cash flow. They come with high exits. And oftentimes you can 1031 from oil to real estate back into oil. Those are the two assets I invest in, okay? In a second, I'll tell you how you can get access to some of that stuff in just a little bit here. Now, let's take $100,000 and I want to show retirement, Dave Ramsey strategy, no debt, all right, versus building actual wealth. If we take $100,000, I don't care if it took you 10 years to save up, 5 years, you already have it, you have $1 million, heck, you could start with 25K, okay? Just giving you an example. $100,000 deployed, getting just a 14.4% IRR in your investment, not the 19.1s or the 20s we're seeing, not including this, all right? If we take $100,000 and we get just a 14.4% in our investment, not the 19.1 or the 20 that we're seeing, and we get this over here, that turns into over $1 million within 15 years. That's what it does. $1 million within 15 years. Not 30 years, not 40 years, not start when you're 20 and wait till you're 59 and a half. It happens in 15 years. Now, if we take $100,000 and say we could actually fund a retirement account right now with $100,000 and we didn't contribute to it again, and we locked it away at that 10% return because we can't self-direct, we don't have leverage, we can't access the money. If we put it away for 15 years, you would get $417,000. So would you rather have 2.5x more than that and more leverage and less taxes and be able to multiply and duplicate and repeat and hedge inflation and not keep it locked away till you're 60 years old? Or do you want to go the broke way, the way that we've been taught? Which way sounds better? Let me know in the comments, okay? The stuff that I do here, I do all inside TCN. It's the Capitalist Network. It's my entire community where you have access to myself, direct mentorship with me, all of my wealth building partners. I don't work with people that are broke. I work with multimillionaires and billionaires. I've got the oil funds, we've got the real estate funds, we've got all of this stuff here under one roof to help you guys accelerate that process. There's a link in the description. It's a 7-day free trial. Let us know if that's something you're interested in joining. You can click the link in the description and let me know what your questions are. I reply to every single one of my intellectual comments, okay? If you leave something dumb, I probably won't reply, but I check, I monitor, and if you have an important question, I will always make time to try to answer as best as possible. Appreciate you guys, and I'll see you in the next video.